Welcome to your daily deep dive, where we cut through the noise to bring you the most important insights from the world of Bitcoin. You know, the space is constantly evolving, and today, well, we've got a fascinating story unfolding. Over the last 24 hours, Bitcoin's been in this tense period of consolidation, holding steady above a critical price level. But beneath the surface, there's a real tug of war happening, shaped by, big institutional decisions, potential regulatory shifts, and major macroeconomic currents.
That's exactly right. What we're witnessing is a market in flux. The long-term bullish story for Bitcoin is, I think, truly solidifying. Yet there are these significant short-term uncertainties that are keeping things tight. It really feels like a coiled spring. And we're going to unpack all the forces that are giving this moment.
Yeah, absolutely. Our mission today is to sift through the data, highlight those crucial nuggets of knowledge from today's market intelligence briefing. We want to make sure you understand what's really going on behind the headlines.
Okay, let's dive into the technicals then. Bitcoin's price has shown some, well, impressive resilience lately. So where are we standing on the charts right now?
Well, resilience is a good word. We're seeing Bitcoin's price consolidating. That means it's trading sideways, in a fairly tight range.
Right.
It's successfully established support above $109,500.
Oh.
And it's even nudged past minor resistance levels around $110,000 and $112,000.
Right.
But for a strong upward move, we really need to see a daily close above $114,000.
Ah, okay.
That would be a real signal that the bulls are back in control, ready for the next leg up.
So that $114,000 mark is key for the upside. What about the downside? What should you be watching out for there?
On the support side, there's a short-term trend line, what we call an ascending channel. That's holding around $111,500 right now.
Okay, immediate support. Yeah, but the most robust support zone, that really strong floor, is between $110,000 and $110,500.
Right.
If we fail to hold that, well, it opens the door for a deeper correction, potentially back towards the $106,000 to $108,500 range. What's particularly interesting, I think, is Bitcoin's position relative to its key moving averages, those lines showing the average price over time. It's currently above its 100-day average, which is generally a good sign.
Okay.
But it's still below its 50-day average. So it's effectively wedged between these two significant trend indicators.
Wedged, yeah, I see.
And that's coupled with a neutral MACD, which is a momentum indicator. So think of it like a tug of war, like you said earlier.
Right.
Neither side can gain a clear advantage right now.
Right.
This kind of indecision, it rarely lasts long, so we should probably expect a significant directional move reasonably soon.
That wedged feeling perfectly captures the current mood, I think. But while the charts show this tense consolidation, it's not happening in a vacuum, right? We're seeing some, seismic shifts in how the big players are positioning themselves. Let's talk about BlackRock's latest move, because this feels like a massive signal.
Absolutely. Huge signal. BlackRock, the world's largest asset manager, just made a landmark rebalancing on September 3rd. And it speaks volumes.
What do they do?
They sold over $151 million from their Ethereum ETF. The ticker is ETHA.
Okay.
And simultaneously poured almost $290 million into their Bitcoin trust, IBIT.
Wow. Nearly double the ETH sale amount into Bitcoin?
Exactly. This wasn't just, a routine adjustment. This was a powerful endorsement. It strongly reinforces Bitcoin's standing as the go-to institutional-grade digital reserve asset.
Yeah, hard to argue with that move.
And just to put it in perspective, BlackRock's Bitcoin trust, IBIT, it now manages $58 billion.
$58 billion?
Yeah. It absolutely dwarfs their Ethereum ETF, which is just under $13 billion.
Incredible difference.
So this decisive pivot, almost doubling their Bitcoin purchases over the Ethereum sales. It isn't just a preference. It's a profound vote of confidence in Bitcoin's long-term value proposition.
And BlackRock isn't the only major player making waves, right?
Yeah.
We've apparently hit a huge milestone for corporate treasuries, companies holding Bitcoin on their balance sheets.
We have indeed. It's really a monumental moment. Publicly traded companies now collectively hold over 1 million Bitcoin on their balance sheets.
1 million Bitcoin.
Yeah. Valued at more than $111 billion. That represents about 5.1% of Bitcoin's entire circulating supply.
Wow. Who are the big players there?
Well, you have firms like Strategy. Many will remember them as MicroStrategy, along with Metaplanet MARA Holdings. They're really leading this charge.
Okay.
And if we zoom out a bit, what this does is it really validates the whole corporate treasury thesis.
Which is?
That Bitcoin isn't just for individuals, but it's a superior long-term store of value. A strategic hedge against inflation, even for major corporations.
Right. Makes sense.
And what this does is create a structural, largely inelastic source of demand, meaning these Bitcoins are typically taken off the market for the long term.
Locked away.
Pretty much, reducing the freely traded supply and amplifying the impact of other demand sources like those ETFs we were just talking about.
That's powerful validation from the corporate world. But what about, the millions of individual and smaller investors? What are the underlying on-chain signals, the data directly from the Bitcoin blockchain, telling us about their behavior? It sounds like this tug of war is evident here, too.
Oh, it absolutely is. We're seeing a clear divergence between what we might call smart money, those high conviction long-term holders, and new money, which tends to be more reactive.
Okay. How so?
Well, data from CryptoQuant shows that Bitcoin whales, the large holders with 1,000 to 10,000 Bitcoin.
Right.
They are clearly in accumulation mode, they're buying.
Okay.
And at the same time, Bitcoin reserves on exchanges have fallen to multi-year lows.
So coins are moving off exchanges.
Exactly. It indicates that a lot of Bitcoin is being moved into cold storage, taken offline for long-term holding rather than sitting on exchanges ready to be sold.
Got it.
Long-term holders are also easing up on their profit-taking.
But there's always a but.
There is. In stark contrast, short-term holders, those who got more recently, they're in a precarious spot. Their profitability dipped sharply during the recent sell-off, and it's only partially recovered. So if Bitcoin struggles to hold that, say, $114,000 to $116,000 range, these less committed holders might sell near their cost basis just to get out without a loss, potentially triggering another downward move.
Oh, okay.
It truly illustrates that tug of war between patient, long-term capital and more reactive sentiment.
So we've got this fascinating dynamic playing out. What about the derivatives market? Where people are trading on future price movements. Is optimism returning there, or is there a different story?
There's cautious optimism, I'd say, yes.
Yeah.
Open interest, or OI, that's the total value of all active futures contracts.
Right.
It's recovered to about $41.4 billion from a recent low.
Okay, that's significant.
It suggests new capital is flowing in, new long positions bets on price increases are being established, and the ratio of long bets to short bets is relatively balanced right now.
But I sense another but coming.
You're right. However, this recovery also raises an important question. Analysts at K33 Research are warning that the amount of leverage, essentially borrowed money, being used in the perpetual futures market is exceptionally high. It's actually reaching yearly highs.
Ooh, okay. High leverage. That sounds risky.
It definitely can be. It leaves the market considerably exposed to sudden price swings or squeezes in either direction.
So a long squeeze where a quick drop in price forces leveraged longs to sell, amplifying the move downwards, that's a real risk right now.
It's a very real risk, yes. Especially if we see any negative macroeconomic news hit the wires. We actually recently witnessed $253 million in liquidations across the crypto market in just 24 hours. And $46 million of that was from Bitcoin positions alone. So this elevated leverage is, I'd say, the primary short-term threat to stability.
Like a tinderbox, waiting for a spark.
That's a good analogy. Any negative shock could ignite a rapid price correction as those leveraged positions are forced to close out.
Okay, let's zoom out then to the broader economy, because that's always a massive factor, isn't it? The latest U.S. jobs report just came out. What did it reveal, and what are the implications?
Right. The August jobs report, it painted a picture of a significantly cooling U.S. labor market.
How cool.
Employers added only 22,000 jobs. That's far below the 75,000 that forecasters were expecting. A big miss.
Yeah, huge miss.
And the unemployment rate actually ticked up to 4.3%. That's the highest it's been since late 2021.
Okay.
Even previous month's figures were revised downward. So this marks the fourth consecutive subpar employment report.
4 in a row.
Yeah. And it strongly strengthens the argument for the Federal Reserve to implement an interest rate cut at its upcoming meeting. That's in just 2 weeks.
Right, the FOMC meeting. So the market's expecting a rate cut now.
Very much so. Some models are now pricing in a probability as high as 91.6% for a rate cut.
Wow, okay. So how does this cooling job market and the prospect of a Fed rate cut, which is generally seen as good for risk assets like Bitcoin, how does that square with historical headwinds like Red September?
Yes. This is truly a major macro inflection point we're at.
Explain that.
Well, historically, September has notoriously been Bitcoin's worst performing month. The average return since 2011 is negative 4.6%.
Ouch, red September.
Exactly. That creates a kind of psychological headwind. Plus, we also have potential risks from, say, U.S. tariffs impacting inflation data. And we're seeing gold surging to new record highs. That could draw capital that might otherwise flow into Bitcoin as digital gold.
Okay, so headwinds.
Right. But you have this powerful historical headwind colliding with an overwhelmingly expected tailwind, that potential Fed easing.
Headwind versus tailwind. Got it.
So the Federal Open Market Committee, the FOMC meeting on September 17th and 18th, that is arguably the single most important near-term catalyst.
Everything hinges on that.
A lot does in the short term. A dovish outcome, meaning the Fed signals a more relaxed stance on interest rates, likely cutting them, that could override red September and ignite a rally.
And the alternative.
Conversely, a hawkish surprise, where the Fed maybe stays stripped on rates, doesn't cut, that could trigger a sharp correction. And it would likely be amplified by that elevated leverage we just discussed.
Right, that tinderbox.
Mm-hmm.
Okay, beyond the day-to-day market movements, it's always crucial to look at the underlying health of the Bitcoin network itself. What's happening there that reinforces its long-term strength?
Yeah, that's a great point. The network's hash rate, which is basically a measure of its total computational power securing the network.
Right.
It's currently at or near all-time highs.
Still, even after the halving and everything.
Still very strong. It signals incredibly strong miner confidence and makes the network more resilient and secure than ever. It's really a testament to the decentralized strength of Bitcoin.
Good to hear. What about scaling? The Lightning Network.
Also positive news there. The Lightning Network, Bitcoin's Layer 2 solution for faster, cheaper transactions, is showing steady growth. Just in the last 24 hours, we saw 35 new nodes and 218 new payment channels opened. It's approaching 4,000 Bitcoin in total capacity now.
Okay, slow but steady growth.
Exactly. It demonstrates growing scalability and efficiency. And it's being driven by major players like Kraken and Block, but also lots of individual operators too.
And what about the core software and security itself? Is Bitcoin's fundamental architecture as solid as ever?
Absolutely. Bitcoin Core version 29.0, the main software, was released back in April. It reflects a very conservative, security-focused development philosophy.
Predictable, stable.
Exactly. And that predictability, that unwavering focus on security, is a paramount feature for those risk-averse institutional investors we talked about. It strongly reinforces Bitcoin's digital gold narrative.
And so the core protocol is solid. What about threats? We always hear about hacks.
Well, regarding security threats, the primary risks for investors have really shifted. They're now predominantly at the application and user levels, not within the core protocol itself. Meaning things like new malware. There's one called the Brokewell Trojan, targeting Android users through fake apps, or the NAZ ransomware.
So user error is the bigger risk.
Increasingly, yes. While some low to medium severity vulnerabilities have been disclosed for Bitcoin Core over time, they've always been quickly fixed, and they don't threaten the integrity of the ledger, the transaction history. This really highlights the critical importance of personal operational security, or OPSEC, for you as an investor.
Like what?
Like avoiding suspicious downloads, definitely using hardware wallets to secure your funds offline, and just staying vigilant against phishing attempts. The threat vector has truly shifted from the protocol to the user.
Good advice. So we've covered a lot today. Bitcoin is truly in a crucial and complex phase, isn't it? Consolidating amidst these powerful, often conflicting forces.
Precisely, yeah. On one hand, you have this undeniable solidification of the long-term bullish fundamentals. Things like the strategic institutional reallocations by giants like BlackRock, that huge 1 million Bitcoin corporate treasury milestone, and a fundamentally robust and secure network underpinning it all.
The deep structural positives.
Exactly. But, on the other hand, significant short-term headwinds persist. The cautious macroeconomic environment, that historical red September anomaly, and a derivatives market carrying elevated leverage, all creating a degree of fragility right now.
It really is a fascinating battle between long-term conviction and short-term reactivity, isn't it?
It is. And the resolution of this current consolidation period and Bitcoin's next major trend will likely hinge on those immediate macroeconomic catalysts, primarily that Federal Reserve FOMC meeting on September 17th and 18th.
The waiting game continues.
For a little while longer, yes. A dovish move from the Fed could be the spark that ignites a rally, while a hawkish surprise could trigger that sharp correction we talked about.
And that leaves us with an important question to ponder, doesn't it? Considering the increasing institutional and corporate adoption, coupled with the inherent strength of the network, how will Bitcoin's role as a global monetary asset and digital gold truly solidify in a world grappling with these constantly shifting monetary policies? What stands out to you from today's deep dive? That's all for your deep dive today. We'll be back tomorrow to continue exploring the fascinating world of digital assets.